This is our final session, and we are so happy to have Oliver Scott with Red Canoe Credit Union back with us. He's going to be walking us through how to read financial statements. Always a need for me. So, and we may have some folks joining here as we go along, but I want to welcome you back. My name, I didn't introduce myself. I'm Dr. Danielle Lord. I'm on the board with the Chamber Collective and happy to be your hostess for our Zooming into Success series. So with that, Oliver, go ahead and take it away. And I'm eager to be a fly on the wall for this one. So
thank you. As Danielle mentioned, my name is Oliver Scott. I am a business loan officer with Red Canoe Credit Union, and I have been a business lender for 15 years. 15 years ago when I started, I didn't know what a P&L was, but quickly learned, and I hope to pass on my knowledge to you all today. Let me go ahead and share my screen again, because we know that the technology works. Great. So what we're going to start off with is a balance sheet. A balance sheet shows what a business owns and what it owes. So it shows what are called the assets and the liabilities. You're probably looking at this and saying, what do all these things mean? So I'm going to walk through all the terminology and what goes into making a balance sheet. The first thing is assets. That's where you start. What does your business own that has value? You have current assets. Those are assets that are like cash, inventory, accounts receivable that will turn into cash within the next 12 months. Okay. Then you have long-term asset. These are things like buildings, equipment, things that will not turn into cash within the next 12 months because they are because they have longer what is called use value. Okay. So then you have liabilities. Those are your debts. Those are what a business owes. You have, just like with assets, you have current debts, which are debts that need to be paid within the next 12 months. Think like credit cards, lines of credit, things like that. Then you have long-term debts, which are debts that will be paid over longer than 12 months. Say a piece of a loan that you might have on equipment or a piece of real estate, what have you. Then you have the current portion of long-term debt, which is the amount of principal that is going to be paid on those long-term debts within the next 12 months. Am I going too fast for you all? Are there any questions so far?
No, so far so good. This makes a lot of sense to me. Yeah, thank you.
Great. Finally, you have equity or net worth. This is where you take the assets that you own, sell them, pay off your liabilities, and what you have left over is your equity.
Okay.
All right, so it's assets minus liabilities equals your equity. Now it's called a balance sheet because assets need to equal liabilities and equity. All right, so there's that balance. If they don't show up the same, then you've made a mistake somewhere. Usually that mistake is in the equity section, and we'll get into the equity section in just a second.
Okay.
So on our balance sheet, you see that we have assets, current assets, long-term assets. I didn't go into intangible assets, but these are things like goodwill. You know, if there is value in the name of the business, or if there is a client list that is valuable, then these go into intangible assets. The reason why I don't use it is because no lender will count intangible assets as anything.
Oh, interesting.
We're only
Yeah.
interested in tangible assets because
Okay.
if we do have to default and repossess your assets, then we're only going to get money from the tangible ones, right?
Makes sense.
So
Yeah.
I don't put it on there, but it is an asset that goes on your balance sheet, intangible assets. Then you have the current liabilities, long-term debt, and you have the equity. And as you see, the total assets equal the total liabilities and shareholders' equity, which I spelt wrong, but there you go. So are there any questions on this so far? I am going to go into depth into all of these subcategories, but just for the time being, are there any questions about assets, current, long-term, liabilities, current, long-term, and equity? Yes, Danielle.
Yeah, thanks, Oliver. I do have a question. So at what point does a business need to have a balance sheet? If I've met little old me, I'm in my third year of operations, and I'm not anticipating going to the bank and asking for any money to fund my operation. So I would not have a liability, and I don't have any liabilities. But do I need a balance sheet at this point?
Yes, you do. Yes,
What
you
if I
do.
don't? Okay, so that's helpful. Thank you. Okay, gulp. But I don't have any liabilities.
That's okay.
So, but then I don't. But then it won't be a balance sheet. Because if I have assets but no liabilities, I don't have a balance sheet.
You have all equity.
Oh, okay. That was simple.
Yeah. And when we get into the cash flow statement, you're going to see why it's important to have a balance sheet.
Okay.
Now, the IRS requires a balance sheet, I believe $250,000 in revenue or more.
Okay.
You're required to report a balance sheet to the IRS for tax purposes, but I would suggest a balance sheet for every business.
Okay, good to know. Thank you.
And like I said, when we get to the cash flow statement, you're going to see why it is important for determining your cash flow. Okay. Any other questions?
There will be more, I promise.
Okay, very good. Give me just a second. I'm going to turn off my light because it looks like it's very glare. There's too much glare there.
Well, while we're waiting for Oliver to come back, that was really informative. Thank you. I had no idea.
That's a little bit better, I think. There's a little bit less glare. So now we're going to go into depth into what goes into the assets and the liabilities and the equity on your balance sheet. The first thing we have is accounts receivable. This is money that's owed to you for products and services that you've sold. So if you have completed a contract and they have 30 days to pay you back, that goes into accounts receivable. Okay. Are there any questions about accounts receivable? We're going to go into how this affects your cash flow in a little bit. But so accounts receivable is money that's owed to you for things that you've already done, products that you've already sold. Let's say you're a supplier, you give your customers 30 days, 60 days, 90 days to pay you back. All of that goes into the accounts receivable. Okay, it's not cash yet. You haven't been paid. Okay, but cash is first and then accounts receivable. Then you have depreciation. This is the deteriorated value of assets. All right. When you buy a car, they say as soon as you drive it off the lot, it's worth a third less, right, than what you just paid for it. That's depreciation. Okay. So you put that onto the balance sheet, and the way that it's calculated is based on the use life of the asset. So if you have a car, for example, usually, and you need to talk to an accountant to get the exact numbers. I'm kind of making these numbers up. But the car will depreciate over 7 years, right? That's how long the car will last on average. And so you're able to deduct 1/7 of the value of that vehicle every year. Okay. And I don't just say that you're allowed to, but you have to, because that asset is going to be losing that much value every year. After 7 years, you're going to need to buy a new vehicle, or it just doesn't have any value anymore for the purposes of your balance sheet. Okay. Are there any questions about that? That's on the asset side. Then you have accounts payable. Yeah, go ahead.
No, I was just going to say these depreciation schedules are generally just, as you indicated, like set by the item. It's not as if to say like, well, I have a Toyota, and so it'll last longer than Volkswagen, for instance, or something like that, right? It doesn't
That
really
is
matter.
correct.
It's kind of just, it's not arbitrary. It's very set, and it is a scheduled item. Is that correct?
That is correct. And that's why you
Okay.
need to talk to an accountant to figure out what those are.
Okay.
I mean, in today's world, you could probably Google it, but an
Yeah.
accountant will give you the exact number based on the newest information.
Okay.
And it's a good point. I failed to mention the other example, which would be a piece of real estate, which depreciates over 20 or 25 years. So you do the same thing to that piece of real estate. You deduct 1/25 of the value every year, and that is the depreciation of that asset.
Huh. Okay.
Okay. Any other questions about the items that go onto the asset side? All right. Then we have on the liabilities side, we have accounts payable. These are bills to suppliers for things that you've received but you haven't paid for yet. Again, maybe they've got you on credit for 30, 60, 90 days. You don't need to pay them for that period of time, but you've received the goods. So maybe you bought some inventory and you haven't paid for that inventory yet. Okay. That makes sense?
Yeah.
Okay. Then you have accrued expenses. These are operating expenses that haven't been paid yet. The electricity bill, payroll that, folks have worked a week, but you pay every 2 weeks. Then it goes on the balance sheet as accrued expense because it is a debt that is owed that week of work that they've performed. This balance sheet is a snapshot in time, so it's on a specific day. So that's why it works that way. So when you run the balance sheet, you should have what payroll is due, and that goes into accrued expenses. I already mentioned the current portion of long-term debt. I didn't realize I put it into 2 places, but that's the amount of principal that you've paid down or that you've paid down in the current year. Okay. Any other questions about what goes on the liability side? Okay. Then equity, you have capital. This is money that you've put into or taken out of the business. All right. This is your investment or your draws. If you take money out and pay yourself to distribute equity to yourself, then that comes out of here. All right. And then you have retained earnings, and this is the profit or loss from your income statement over the period of existence of your business. How much money have you kept into your business, or how much money have you made in your business over its life, right? And you take those two things together, and that's how much equity you have. So let me show it to you on the balance sheet. I showed you accounts receivable. Inventory is obviously your inventory. Investments in stocks and bonds and things like that that you might have. Land, building and improvements, equipment, minus depreciation. On the liability side, you have accounts payable, how much you owe to your suppliers. Notes payable, this is the current liabilities. So again, the stuff that needs to be paid within 12 months. Accrued expenses, and those are your current liabilities. Then you have your long-term debt, and you have your total liabilities. Shareholders' equity, you have paid-in capital. Common stock is usually for bigger corporations than who I presume we are dealing with today, but that is investment by others into your business. All right. Retained earnings, again, that's your profit or loss. And you have the total liabilities and shareholders' equity, which equals the total assets. Are there any questions about that?
No, that was a really clear explanation. I like the way you phrase common stock as just the amount of basically, you know, payments that people have made into your business that way. It really makes it clear that that's what the stock, common referred to as stock, is sort of an exchange for, and that's really nice. And don't mind me, I am just pulling up QuickBooks so I can take a look at my balance sheet at the same time
Cool.
that you're, yeah.
Very cool. All right.
Well, Charity, at least you have a balance sheet, so.
Thanks, QuickBooks, right?
Yeah. QuickBooks helps out a lot. All right. So now that we've done the balance sheet, now we're moving on to the income statement. As I mentioned, a balance sheet is a picture in time, right? On a certain day, this is what you own, this is what you owe, and this is what equity you have on December 31st, 2024. An income statement is more like a movie. It is over a period of time, right? So how much you are earning from January 1st, 2024 until December 31st, 2024. Just as an example. All right, so over a month or over a year or however long you're looking at your revenue and expenses over that period of time. And I'm going to get into what all those things mean. But this is a sample income statement. It shows you, again, your revenue, how much you spend, and any other income that you might have, other expenses, and then your net income. And what do all those things mean? There's a lot of slashes on this because it's called different things. An income statement is also called a profit loss statement, which is often shortened to P&L statement. They're all the same thing. All right. They are a statement of your earnings and expenses and profit or loss. So revenue, also called income, also called sales, is how much money a business generates from selling your products and services. Pretty straightforward, right? Every receipt that you receive for payments received goes into your revenue, income, and sales for your everyday business activities. We're going to get into other income later. Or we could get into it now. Other income is kind of if you sell a piece of equipment and make some money off of it. That's not part of your daily business activities, so it doesn't go into sales and revenue. It goes into other income. So think of it that way. If it's what your business is normally doing, then it's sales revenue. If it's not, then it's other income. Okay. Any questions about that?
Yeah, I have a
Okay.
question.
Mhm.
A lot of my products through my business, Archetype, are digital products.
Okay.
Is there a inventory requirement around that, or how do you account for inventory around that?
Well, it's interesting, and I honestly don't know the answer to that question. I would not count it as inventory because it's not something tangible.
Not tangible. Yeah. Okay.
Right.
So think about inventory then as just purely tangible items.
Yeah, I would consider that to be the value there to be intangible assets.
Oh, okay. All right.
Right. So that's where I would put it, and talk to an accountant about exactly how to value it. But my thought would be to value it at the amount of cost that it took for you to produce it.
Produce it. Yeah. When it's IP,
Right.
gets a little
Yeah,
gets a little tricky.
totally.
Okay. Yeah,
Yeah,
helpful. Thank you.
no problem.
Yeah.
Sorry, I didn't have a better answer for you.
No, that's okay. It was an answer.
um, any other questions about revenue, income, sales? Okay. The next line item is cost of goods sold. It's also called the cost of sales, but I like COGS, short and sweet. This is how much it costs to produce the products and services that you've sold. This is where the balance sheet and the income statement play into each other a little bit, because the way that you calculate cost of goods sold, if you're not making financial projections, but rather going off of actual historical um, um, revenue and balance sheet, you take your two balance sheets from the beginning of the income statement period and the end of the statement period. You add the beginning inventory, you add the inventory purchases, and you subtract the inventory that you have left at the end, and that's your cost of goods sold. The concept being that you are starting with a certain amount of inventory, you're buying more, and you end up with what you end up with, and that is how much you spent on the inventory that you sold that month or year. Okay. Does that make sense? I know it's a little convoluted, but we'll talk a little bit more about it when we get to the cash flow statement as well. But are there any questions about cost of goods sold? No? Okay. When you take your revenue and you subtract your COGS, you get the gross profit. That's how much income is left over after paying the cost of producing what was sold. And the the gross profit margin is just percentage. All right. So if I can move on to the sample that we have here, you see we've talked about revenue. We've talked about the cost of goods sold and the gross profit. So they sold $144,000 worth of products and services. It cost them $43,200 to provide those products or services, to produce those products or provide those services, and they have a gross profit of $100,800. Okay, and then this 70% shows their margin, right? So they have a gross profit margin of 70%. All right. So it's costing them 30% to produce their goods and services. Does that make sense to everyone? Excellent. This is called above line. All right. It's everything from the gross profit up.
Okay.
Okay. Then you have your expenses, your operating expenses, how much money a business pays for general and administrative purposes, salaries, insurance, rent. All of these things are operating expenses that will go into those line items, all right, on an income statement. I already mentioned other income. Other expenses are the same kinds of things, non-operating expenses, interest expenses, depreciation, and then you have net income, profit or loss. It's the bottom line. All right, everything else was above the line, COGS up. Now operating expenses, once you subtract those from your gross profit, then you have the net profit or the bottom line. This is how much income is left after paying all of your expenses. So again, it's income minus your costs of goods sold, minus your operating income or operating expenses, sorry, plus other income / expenses equals the net profit. Any questions about that? All right, let's take a look at it. Here we have advertising, bank charges, insurance, payroll taxes, blah, 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 wages. These are all operating expenses. Net income, this is your profit margin, your net margin, all right? Then you have other income, other expenses, interest expense, net income loss before taxes after taking in your other income and subtracting your expenses. And then you have your net income at the very bottom. And this is the bottom line. Does that make sense to everyone? I feel like I'm going very fast. So if I'm going too fast, let me know.
It makes sense, but like, and I don't know that you have to know the answer, but like, why is it broken out like that? Where you have, revenue and income, and then expenses, and then you've got more income. Like, it feels like it would be much clearer for everyone if it was combined in different ways.
Right.
Why?
It's just so that we know what income is not being generated from normal business activity, because that might not continue moving forward. Right?
Okay. So it's for purposes of evaluating basically the company's bottom line. Okay. Bottom line. There we are. Okay.
Exactly right. Because like I said, you might sell a piece of equipment, but are you going to do that every year? So is that income that you can count on forward? give you a better idea of what you're actually generating from your business activities.
Okay.
No
Thank you.
problem. Nope. Any other questions before I move forward to the cash flow statement? All right. So the cash flow statement is where you take your sales revenue and you consider, you take your income statement and you compare it to your balance sheet and you come up with what your actual cash position is, how much cash your business has. And it's a little complicated, but bear with me and we'll try to get through it. But if you do have any questions, I am here. So you start with the sales from the income statement and you add back depreciation from the income statement because depreciation is not a cash expense. It's just the depreciation of the value of your assets, right? So you add that back. Then again, taking two balance sheets from the beginning of the period that you're analyzing. Yes, I'm sorry. Did you have a question? No?
No,
Okay.
I'm good.
A balance sheet from the beginning of the period you're analyzing to the end of the period that you're analyzing. You add back the decrease in accounts receivable because that's money that you were paid, right? The increase in accounts payable because that's money that you paid out, and increase in taxes payable. That's money that you paid for taxes, all right? And you subtract the increase in inventory because that's inventory that you purchased. Does all of that make sense? Yeah, I know it's
In
a
the
little
moment.
complicated.
It all makes sense now when you say it, and 30 minutes from now it'll be like, wait, what?
That's why it's recorded, right? So you can always go back and
Good reminder.
but basically it's measuring your cash inflows and outflows, right? As opposed to just the income and expenses, it's looking at how much money you're actually bringing in and how much money is actually how much money is actually going out. And instead of money, I probably should have said cash because it's a cash flow statement. So how much cash is coming in and how much cash is going out. Accounts receivable are not cash yet, right? So you're only adding the change in those accounts receivable because that's money that you have received. That's cash that you have received. Okay. Same with accounts payable, same with inventories. These are expenses that you have actually paid. And so they either deplete your cash, basically. So any other questions about those the use of the balance sheet for developing your cash flow statement? Okay. The next two are adding, subtracting cash flow from investments. Let's say that you bought some equipment for your business. That's cash that you needed to pay for the purchase of that equipment. And then you add any cash flow from financing. So because if you got a loan to pay for that equipment, then that's cash that came in, right? To your business. So you bought $500,000 worth of equipment. You financed $450,000 of it. You're really only out $50,000 of cash. Okay. And I should have said add cash flow from investing, because if you have investments that have in stocks and bonds or whatever it might be that have returned money to you, then that's additional cash as well. Okay. Any questions about that? If not, we can move on to a sample cash flow statement. You have your net sales revenue. Again, you add back depreciation of your assets, the decrease in accounts receivable, the increase in accounts payable, and the increase in taxes payable. Then you subtract the increase in inventory, and you get your net cash from operations. Now, usually, at least from a credit analysis point of view, this is the number that we're interested in, right? Because it shows the health of your company based on just the operations of the company. Then you have the cash flow from investing. In this case, they bought $500,000 of equipment. Notes payable, this is debt that they took on of $10,000. This cash flow is how much cash is actually left over. This should be the number that is on your balance sheet, right? At the end, right? If it doesn't equal the balance sheet number, then you made some calculation errors. You've forgotten to do something, right? And the other thing that I wanted to say about it is that while the net cash from operations is the main analysis tool that we use, it is important to see that a business from its operations is able to fund its own investments, right? So in this case, they made $2 million in net cash, and they were able to invest $500,000 into equipment, right? So that shows the strength of the company. Does that make sense?
Yeah.
Okay.
And they didn't have to add a liability to do it.
Right, exactly. They only got this little $10,000 loan, right? Or who knows what, but yeah. So it demonstrates the real strength of this company. And I believe that that is all of my presentation. So before I'm done, are there any other questions about the cash flow statement?
Wow.
I know. Oliver Scott with Red Canoe Credit Union, making financial statements sound easy.
I know. This was such a clear explanation of kind of these larger things to be aware of, or sort of chunks to pay attention to in thinking about. And like, as you said, like if you get to the bottom of your cash flow statement and it doesn't match your balance sheet, I think those kinds of bits of information are really important. For instance, I have a journal entry I have to make every month for my payroll for my business, and I have made a mistake before in which order I kind of put things in. And then there's a quick report that you can run, right? Where you go, well, this number no longer matches this number, and you, that's a mistake, right? And so I think I love the way that accounting works in that way. I understand it's obviously structured that way. It was invented that way, and it works great. These like little checks and balances, and so I think those kinds of things are really helpful. Those insights are really helpful to know how things work together, right? How they sort of interlock and intertwine, but then also how to know when you've made a mistake. Like this is how, this should match here. If it doesn't, go back to the drawing board. This should match here. If it doesn't, like, it's very helpful, I think, for the beginner or a person who's just sort of starting out to know where those red flags are, because otherwise you're just going to continue plugging along thinking that things are great because you've got QuickBooks. But
Yep.
guess what? QuickBooks itself is not really checking your math. Not really. And so you have to know at what point to kind of look back at these reports. I remember you said, so cash flow numbers need to hit the balance sheet. Are there any other internal references between those that you want to just give me one more time so I can kind of highlight maybe in
Sure.
a quick write-up?
Yeah. So again, you're adding back to your net earnings, you're adding back the depreciation.
Mm-hmm.
You're adding back the decrease in accounts receivable because that's cash that has actually come into you. You're adding back the increase in accounts payable because that's money that you haven't paid yet, right?
Right.
And you add the increase in taxes payable for the same reason, right?
Okay. Mm-hmm.
Taxes that you haven't paid yet. So those are all things that get added back to your cash.
Okay.
And then you subtract the increase in inventory because that's inventory that you've purchased.
Got it.
Okay. Now keep in mind, and when you add a negative, it's subtracting, right? So if there's a decrease in accounts payable, that means that you've paid more bills, right? And therefore your cash went down, right?
Mm-hmm.
So
I see.
don't forget that. If your accounts receivable have increased, again, you have incurred costs that you haven't been paid for yet. So that is a decrease in your cash as well, right? Does it make sense? So that's why I put it this way in saying additions to cash for these things. But if they are negative, then they will have a negative impact on your cash, right?
I see.
Same with a decrease in inventory will be extra cash. Like
Right.
stuff that you've
Got it.
sold and you haven't bought new inventory yet. So, yeah.
Interesting.
Hopefully that the way that I put it makes sense.
Yeah,
I
that
think
was helpful. Thank you so much.
no problem.
Yeah.
Yeah, thank you so much, Oliver. Wow, again, put your other screen up so people can see how to get a hold of you if they need to.
Yeah.
I might be reaching out to see if you do this on the side for folks who are completely financially illiterate like myself, but thank you again. So Oliver Scott, a business loan officer from Red Canoe Credit Union, and making financial statements sound really easy. That was super helpful, Oliver. Thank you so
Thank
much.
you. Thank you for
Yes,
having me.
thank you.
Yeah, great to have you back. I hope we see you back again next year. Charity and I are working on the calendar of events for next year, so we hope to have a pretty exciting lineup. So for now, sorry, as I lose my voice through this, I have been talking all morning. Thanks for joining us. If you're watching us on YouTube at a later date, go ahead and click like. I'm trying not to say smash the like button because I just did a whole presentation on trauma language today. So click the like button and be sure and leave a comment and we'll get back to you if you've got anything to add or any questions. And